Global markets are still experiencing weak performance. That's as world economic growth fears amid stubbornly high inflation and the likelihood of continued monetary policy tightening dominate developments. Head of Foreign Exchange Execution at Rand Merchant Bank, Matete Thulare, joins us now for more details. Matete, good morning. There are also developments in oil, a slip due to the uncertain global economic activity. Tell us more about that.
Good morning, Hugo, and happy Friday. Look, I suppose for oil markets, we've headed for their first weekly loss since last month's banking crisis that we saw, obviously weighed down by concerns over the demand and also the U.S. economy. Now, fuel markets from gasoline to diesel are flashing signs of weakness, whilst the Federal Reserve Bank has said that the U.S. economy has stalled in the recent weeks. Now, the prospect of further monetary increases in interest rates has also added to these headwinds, and I think it will see oil likely resume its month-long downturn, especially after the post-OPEC price action that shows that demand concerns dominate the near-term narrative. Now, the recession fears from the rising interest rates and also the International Monetary Fund 2023 growth warning is continuing to overhang on oil prices. And I suppose also another factor is obviously Chinese oil demand has fallen short of market expectations over the coming months. So it just tells you a story that unfortunately those rumors about a potential recession are obviously impacting the oil prices, and that's why you're actually seeing these weak oil prices despite the OPEC price cut, that supply cut that we saw a few weeks ago.
What's projected as a close to global market activity in this week's trade?
Look, from a flow side, it's been a really choppy week with the JSE obviously in really volatile trade. I suppose we set to end the week on the back foot as Asian markets retreated after a soft session overnight in the US last night, and risk appetite is taking a bit of a hit this morning. I mean, data showing that the softening in the US manufacturing and the labor market data is obviously just something that the market is watching for. We're seeing broad-based selling across Asia, also as a back of Joe Biden signing an executive order in the coming weeks that will limit investment in key parts of the Chinese economy by U.S. businesses. Already just from a local front, you are seeing fixed income fund flows recording about $77 million worth of outflows compared to the prior inflows of around $20 million. From an equity fund perspective, we've even seen outflows there. Also on a 7-day rolling average, there's been outflows. But if you look at the EM space from an equity fund perspective, there has been record inflows to the tune of around $230 million. So it tells you that it is a mixed bag of things that are happening in the market. But I suppose, as I said, it is going to be a choppy end to the week.
Now, news just in from the G7 is that countries which are meeting in Japan next month could agree on a total ban of exports to Russia. Matete, this is an interesting one.
Look, I mean, some of Ukraine's key allies, including the U.S., are considering a move closer to an outright ban on most of the exports to Russia. Now, this is a potential significant tightening of the economic pressure on Vladimir Putin over the war that we have seen over the past couple of months. Now, the G7 officials are discussing the idea ahead of the leader summit in Japan next month. Now, the aim would be to include the European Union members in the crackdown, and I think the proposal is still being debated and could potentially change. Now, the approach is being discussed by diplomatic envoys, which obviously would flip the existing sanctions regime around all the exports unless there's certain things that are exempted. Now, some of the G7 leaders would endorse the move at the summit potentially next month, but what exactly would be excluded then would also have to be agreed, with things such as medicine and agricultural products, including food, very likely to stay exempted. So, look, it is an ongoing fluid situation. I think we're going to have to watch the headlines ahead of the summit next month before we can actually know what exactly this total ban could also include.
Well, speaking of exclusion, President Cyril Ramaphosa not being invited, is that significant because Russia and South Africa have BRICS? Who is bigger, more powerful between G7 and BRICS, or there's more to it than that?
Look, I think it's very interesting because unlike Canada, France, the UK, Germany, which have hosted President Ramaphosa as an honored guest at their G7 summit in 2018, 2019, 2021, and 2022, it is quite interesting that now Japan did not invite him to next month's G7 summit in Hiroshima. Now, President Ramaphosa has said that South Africa is not disappointed that it has not been invited to the summit next month. This time they've given the invite to the AU chair. And as South Africa, we are pleased because that gives recognition to the continent. Now, remember that the summit will take place in Japan, in Hiroshima, from the 19th of May to the 21st of May. Last year already, President Ramaphosa participated in the same summit at the invitation of the Chancellor of Germany. Now, the Japanese embassy in South Africa has explained that South Africa has not been invited because countries selected for the outreach are those beyond the G7, and those are centered in the global south, playing an active and significant role in global peace, stability, and economic order, or those that are showing a strong motivation to do so. Now, you can read it in any way that you want to, but remember there is the geopolitical tensions that are happening across the world. So it is quite an interesting one that is playing itself out, and I think also the outcomes following the summit on the 21st of May will also be something that we'll need to read into as to where some of the global leaders are thinking.
Well, let's go social now. The parent company of Facebook, Instagram and WhatsApp has put out an alert that it's letting go of 10,000 people. Talk to us through what is happening there.
Now, if you think about it, Meta, which also owns Instagram and WhatsApp, has been under pressure since a sharp slowdown in its ad revenue business last year. Now, Mark Zuckerberg has said that the layoffs are key to making the company more efficient, and said the cuts were, to adjust to a new economic reality and to enable the firm to invest in the future. Now, it has already let go of about 13% of their staff, which is around roughly 11,000 people last year. Now, in March, people on the recruitment team were the first to leave the company. Now, the newest notifications that have came around are those that are working in the firm's IT teams. Now, another round of layoffs are affecting businesses and administration teams, which is expected to come out next month. Now, the move comes as the corporate world is bracing for a wider economic slowdown. Like I said earlier, there is talks about a potential recession, as also the higher interest rate costs are starting to affect business activity globally. Now, the tech sector and the tech industry, which has had low borrowing costs, has helped fuel investments and growth, but that has not been particularly hard hit. And I suppose this is why you are seeing the layoffs that have been coming through from the tech sector, including the likes of Facebook.
Now, finally, Oceana Group is finalizing its financial results for the 6 months ended March. What expectations from those set of results?
So the investment holding company, which is Oceana, it has interest in fishing, cold storage, and shipping, says that their first half earnings, they're expecting that to have an increase of around 136% to 156% year on year. The headline earnings are also expected to rise by around 135%. Now, the financial performance has been mainly achieved through the higher opening inventory levels that the company had. There's been strong volumes in the canned fish business, which have obviously been offset by the increased cost pressures and also the firm international prices for things such as fish oil and wild caught seafood. But if you think about it also, just in January, the company had hiked prices and said, they planned other increases on the back of fuel and also the cost pressures in the freight sector as well. So I suppose despite all of that, I think it's a really great set of results for the first half of the year.
Matete Thulare with the markets. Good morning.